Welcome to another episode of From Startup to $250 million. How to use accounting and finance to grow your business. Today, we're going to talk about from $20 million to $50 million. And I want to introduce to you Eric Rourke. He's going to break this down for us so that we can all understand as business owners how to grow our business using accounting and finance. Welcome to the show, Eric.
Thank you, Thomas. And I just want to say congratulations to all you business owners that are cresting that 20 million in revenue. It's a very elite group. You guys are fantastic, and you guys are what are driving the economy and business today.
Let's just dive right in. So tell us the biggest difference. We've already talked from startup all the way up to $20 million. What's the biggest difference when you move from that stage from 20 million to $50 million?
I got to tell you, Thomas, as you go through, and each stage we're talking about is a little different, but there's almost like just kind of star stages. It's like when your baby goes to a toddler, or from a toddler to a teenager to adult. They're just big changes. And this $20 million mark is really big for a lot of companies. And it does depend on your industry. But really at this level, what happens when you're a smaller business as an owner, you've got just an amazing for your business. And it's just astounded me how many business owners that I've worked with, and I go back and they do some stuff off the top of their head. And I look at it and I'm like, you're right. And it's 80-90% of the time you're right, maybe even more. But as you grow larger and it becomes more diverse and more spread out, it's incredibly harder to do that because you don't have the feel and everything in front of you. So really at this level, what you're looking to do is you're looking to manage by numbers, right? So in the past, it's been look and feel, and I could go out to the shop and I'm there. But at this point, there might be different shops in different areas. The company, there's a number of employees, departments, the building gets huger. So you really got to start making that transition from the feel and being able to see and touch everything to really starting to manage by numbers. And that's a huge difference.
So managing by numbers, that's really what kind of reporting you have.
Yeah. And I think this gets confusing. And I talk to a lot of folks about this, and they say, hey, I've got my taxes. And when you're first starting out, it's about taxes, right? Mm-hmm. You want to minimize taxes as much as possible. And that's the biggest person that you're reporting to besides yourself. So tax reporting is important, but you got to realize, Thomas, tax reporting is different than other reportings that you need to do. The tax laws are really put in place by the government, either whether it's federal, local, or state government. And so while there's accounting rules and principles behind them, whenever you're reporting for taxes, it has some deviations based on the tax laws. And usually those are driven by economic stimulus and things that what we're trying to achieve more globally from a government.
So if you're doing something from a tax reporting, like how do you start shifting towards more management based or other types of reporting?
Yeah, and I got to tell you, the next one, so as you start with the tax reporting. The next one that's really important is the management reporting. And hopefully you've already started putting that stuff in place as you're growing to be able to get there. Not all people have. We've seen really large companies without a strong management reporting base. And what is management reporting? So you have your tax reporting, which is to the government, and your management reporting is to your internal staff and team. Well, I think one of the most important things about accounting and finance is really partnering with the business and letting them know the repercussions of the actions that they're taking or what they're doing, both positive and negative. I know a lot of people think of the negative, but positive as well. Hey guys, we're doing this well and we need to continue to do it. Or, hey, this didn't work out like what we thought, or we're going over budget and we need to change. But some of the major reporting elements that you should be looking at for management reporting are KPIs, key performance indicators. So really at this point, you should be looking at your different departments because you should be departmentalizing at this point and saying, hey, what are the important numbers that we need to accomplish? So if it's sales, you're probably going to look at sales. You may look at margin. There's all sorts of different avenues. You may look at activity, right? They're not all financially related. Some of them are activity related. If you're looking at operations, depending on your operations, you're going to look at efficiency. You're going to look at overtime, things like that. So KPIs are really important to be able to drive the business. And really, you should be looking for financial analysis, right? When you're doing accounting, it's great. Accounting's reporting the numbers and reporting the past. But now you should really be digging in and doing that partnership and saying, hey, have we looked at this? Or we're spending money here. Does that make sense? Or we're getting a better ROI here by this investment. And the management reporting encompasses quite a few things, also including budgets and forecasts. And when you're getting to this size of company, you really should be putting in budgets and forecasts to be able to see what are our goals for this year and where are we going. And it's a great indication for a number of things.
So you have your reporting for the taxes, and you've got management reporting, which is really internal focused. What is there anything else that you need to be thinking about from a reporting?
Absolutely. So as you're moving in this level, there's going to be more increased scrutiny on your financials, and people wanting to see your financials as you look for maybe investment capital, looking to do acquisitions, to borrow money, things like that. And that's the external reporting factor. And this is going to be focused on people that are external to the organization. Now, what's interesting as you grow your business, there's different, even whenever we get into the different types of reportings, there's different types of basis which you report. So we talked a little bit about tax. That's, you're going to report to them on a tax basis, how they want to see it. And interesting for taxes, there's this thing called cash basis versus accrual basis. And I know this is confusing, but think of cash basis as like checkbook accounting. So when I receive cash, I got revenue. Whenever I write a check, then I have an expense. That works great as you're growing. A lot of people do it. It's very popular in small businesses. And your taxes will allow you to do that depending on your industry. But depending on your industry as well, you may have to go to accrual basis. And accrual basis is very different. So accrual says it doesn't matter when I collect cash or cut a check. It really matters when I delivered that product for maybe revenue recognition, or when I incurred those costs, say consulting fees or something like that. It's not when I paid it whenever I drove the expense, it's when they did the consulting. Now, this accrual basis is also known as GAAP, which is generally accepted accounting principles. So if you go outside of the company and people are looking, investors, lenders, they all want GAAP financials. And that's based on an accrual basis, not as opposed to a cash basis. So that starts becoming very important. But these GAAP-based financials are all the language of the outside investors and lenders. And the reason why is because when they get financial information, it needs to be comparable. So if I go to company A and I go to company B and I go to company C, if they all have different ideas of how things should be accounted for, then it's very hard to compare and understand the numbers. But accrual basis, and then it goes into FASB and all these other things, it really sets the tone and the standard for here's what financial statements mean when I get them. And look, you're going to do a better job of matching expenses and income in the periods. It's going to give you a better idea of how your business really runs.
In our last episode from 1 to 10 or 1 to 20 million, we talked about CPAs. How's the relationship with a CPA change in this stage of a business from 20 to 50 million?
Certainly. You're probably going to, and we encourage even at startup, get a good tax CPA. I think it's such a good, important point. I'll emphasize it again. But now you're going to start working with potentially the assurance side of the house. Some of the smaller CPA firms don't differentiate that. The larger ones typically do. And that's going to be able to fill some of these external requirements. You're going to have information and financial statements that you present in your company, but it might not be in this form or this standard. And that's where your CPA gets involved. And they may do 3 different levels. So there's a compiled financial statement, there's a reviewed financial statement, and there's an audited financial statement.
So that's a new term for me. Can you talk about what each of those kind of are, really?
Certainly. And if you're not an accountant, maybe those aren't the terms that off the top of your head are CPA. If you're CPA, this is what you do every day. Mm-hmm. A compiled financial statement is basically where the CPA takes your numbers and puts it in the format. They don't do any kind of scrutiny on the numbers. They're just literally taking your numbers and putting it in that format. Now, if they see something blatantly wrong, obviously they're going to bring that to your attention, or should bring that to your attention. But their deal is just to get it in the format, right? Mm-hmm. So when you go to a reviewed financial statement, this is all the stuff I used to do when I was working for the CPA firms. A reviewed financial statement gives what they call negative assurance, right? It means, hey, we looked at it, but we didn't find anything wrong. Okay. So typically what you'll see in a reviewed financial statement is a lot of analytics, comparatives, just to see, hey, does this make sense or does it not? And then are a little bit more increased scrutiny on presenting in the format. But a lot of people think, oh, the CPA did this and my financial statements are true. That's not necessarily the case because they're just reviewing it at a very high level. So again, negative insurance, we didn't see anything wrong. Where you really get the good, strong financial information from the CPAs, pardon me, is in the financial statements. So an financial statement is where the CPA is going to affirmatively ensure that it's materially correct. So if it's $5 off, most businesses, that's not material. If it's $1 million off, most businesses, that is material. Just to give an idea of materiality. But in audit, they actually go in and they check and they do work to support the balances. So they make sure and pull invoices and look at agreements and all these things. And that's where you're really getting assurance that your numbers are strong or materially accurate. And they do a whole bunch of procedures to do that. Very important. And depending on the level of borrowing, investment, your industry needs, like construction typically need reviewed financial statements. ESOPs will need reviewed or audited financial statements. Publicly held companies absolutely need both audited and reviewed financial statements. Will depend on your engagement. But I think that's just important to know the difference.
Okay. So in our last round, we talked a lot about spending a lot of your internal resources and staffing on things like sales and marketing and operations. What about, and then using back office stuff like outsourcing as much as possible? What does it look like in this stage from a staffing, in particular around accounting and finance?
Yeah, absolutely. Outsourcing was great whenever you're smaller because you get experts in that area and then a cost-effective way because you don't need them full time. But as you're growing to this level, you really need to start looking at insourcing and bringing these people in-house because at some point without it's not going to be cost beneficial. And this is really the time to start looking at that. But gosh, we just went through a whole bunch of stuff of managing by numbers and looking at all these different types of reporting and maybe different involvement with the CPA firm. So this is really the time when you see a lot of companies in their first controller. They're going to continue to add staff, and that becomes a part of the insourcing efforts that start to make sense. Obviously, based on your industry, when we look at an e-commerce or retail, those revenue numbers start climbing a little bit more quickly than, say, a manufacturing business or something like that, just because there's so much volume that goes through. But you're going to want to adjust appropriately, but really start looking at that first controller and bringing on the staff internally to support them.
Okay, that's great to understand, like the staffing changes. What about systems? What's going to change really in this stage and from 20 to $50 million?
And it is, guys, about people, process, and systems, right? So we just talked about the people. Obviously, the processes are going to need to mature because there's so many people that are out there. And then you need the systems to support that. And accounting system's one thing. And most of the people that are watching this is probably on QuickBooks, at least at this day and age, or QuickBooks Online. And that's really good for just the accountants and the accounting. But when you get into larger companies where you're more geographically dispersed and more departments, it becomes more efficient to enter things in. You're going to want to look at an ERP system. So that's enterprise resource planning system. Really what the difference between an accounting system and ERP system is, the accounting system is literally just the accounting system. The ERP is the company system. And that's what everybody in the company uses. And you drive that efficiency and that communication by being able to use that type of system. And so you're going to want to look at areas for operational efficiency as well. So that's really important at this level.
So putting in a whole company system, that sounds like a big undertaking. What is that implementation like?
Thomas, it is huge. And I got to tell you, if I'm being optimistic, most system implementations are long, frustrating, and over budget. And I won't say everyone, but it is. And we've actually seen this really impact companies. Because the first thing when you implement a system that you want to look at is you want to look at like the different parties that you have that are involved. Look, these are your customers, your vendors, your employees, your inventory management, your revenue generating machine. So if these things are going wrong, it's going to have a tremendous effect on your business. I will say the nice thing though is if they're going right, you have a single source of truth. But if you're looking to implement an ERP system, the first thing you're going to want to do is know your processes and know what you want to achieve. So what is the difference in the delta? There's industry specific softwares as well as more general softwares. There's the idea of what's called best of breed, buying different softwares to make them integrate, or a big package. So it's going to be very important. And spoiler alert, you should be looking for change. I can't tell you how many ERP implementations that we go into and they go, it didn't work like the old system. Of course, you don't want it to work like the old system, right? If it did, why are you upgrading? You want it to work better, different, faster, more efficient. So sometimes that's a little tough, but really being able to, and this goes into, you got to prepare a good systems requirements, right? Know what you have, know what you want, and really specifically say that. Some people will call it an RFP. And don't just look for today, look for the future. You are going to have to, if you're going to grow tremendously, you're probably going to have to go through a series of ERP systems. And you're going to want to look at one of these good mid-grade systems that are out there. Microsoft has good products. Sage has good products. NetSuite's very popular. A lot of these are industry, again, agnostic in those packages, but there's some very industry specific ones. But if you're not sure, I'll tell you what, when you get into that phase, it's going to understand one thing and you're going to understand another, but you bought the system. And so you're going to want to really dig into that and make sure that you understand. And then when you're looking at systems, you want to weigh the cost of the future versus the needs of today, right? So the cost of an SAP is huge, right? There's a lot of programming and things like that. You'll never probably outgrow that system. But then the same time, you will have to upgrade. So it's kind of like Goldilocks and the Three Bears, right? This soup's too hot, this soup's too cold, and this soup's just right. And that's why it's so important to understand your needs. And then a lot of people think about, oh, I get all the stuff in the system, but inputs are one thing and outputs are another. So pro tip, don't forget the outputs, whether it's a BI tool, digital visualization tools, reporting systems, you got to get the information to the different tax authorities, to the different management members, and to the CPAs to help with the external and investors and lenders.
So that's a major undertaking that you just walked us through. Huge. For a business owner who's in that $20 to $50 million range, what is there some kind of like advice that you can pass on as having oversaw a lot of these? What would you give them?
Absolutely. We could do a whole series on this, Thomas, just alone, because there's so much. But what I'll do is I'll share with you guys my biggest mistake, right, in implementing system. And whether it was budget or support or whatever reason, we all go through these. Hey, it's going to cost more, and geez, what do we get? And this analysis. But my biggest mistake was you got to bring on the resources. So if you look at your accounting and finance team, they're typically at best case utilized and not uncommonly 100 or 110% utilized. So if you bring on, this is a big project, and if you don't bring on additional resources, then your project gets delayed, which is affecting your customer, vendors, and employees, like we talked about, inventory systems, things like that. The costs go up, right? It's a huge business distraction to everybody in the organization. And at the end of the day, you get frustrated staff and people who leave during the process. Thomas, we've seen this cost hundreds of thousands to millions of dollars by not planning ahead of time properly. That reduces so much, and it becomes so much more efficient and less frustrating if you bring on the resources ahead of time. So your short cost of the additional consultants versus your long cost could be a tremendous ROI for your business.
That was major, the ERP system. Another thing people start thinking about at this stage is, should I buy a company? Should I sell my company? Start thinking about those things. Can you talk a little bit about that, and in particular what business owners should be thinking about in this stage?
Absolutely. And I hope everybody's starting to think about M&A at this stage if you want to grow tremendously. And there's a lot of different ways to look at that. And like you said, buying or selling a business. The first thing I would tell somebody is run your business as if you were going to sell it. And the reason for that is that's the best way to run a business typically, because what you're trying to do is maximize the value, get reporting information, build scalable systems, look at intellectual property and things like that. So if you keep that mindset in mind, what you're going to do in the long run is build quicker and better enterprise value. But in the short run, it actually affects your profitability in a positive way, because you start seeing that and you start building that system. And look, the best opportunities come when you're not looking. That's just, I don't know if it's a law, maybe it's a deviation of Murphy's, but so you want to be prepared. If someone comes in and offers you just ridiculous amounts of money because of whatever, if you're not in position, you could lose that. And there might be a time when you want to exit. Unfortunately, there are life things that happen where people say now's the time. And if you're not ready, you leave a lot on the table. But Thomas, one of the things from an M&A perspective, I would encourage business owners to do is start thinking about, whether you execute or not, pardon me, start thinking about acquiring smaller companies. M&A is a practice and you don't always get it right the first time. So if you can start with smaller businesses, and look, this can be very synergistic. There, you could get businesses that could add in your product line, could expand geographically in other areas, maybe businesses that are hurting. So if they're going through a down economic time, but it's got a good base and good people, you could acquire that business. And that goes back to some people do what's called an acqui-hire, right? So they do an acquisition because the talent is so strong and that talent pool is there that it's just easier than hiring them directly. Companies that have that, but you can find tremendous value, but you got to be positioned. And if you're doing the acquisition part where you're actually buying the business, you have to be ready with the financials and the relationships and all that information to be able to take advantage of great opportunities.
Well, Eric, that was fantastic. This is an exciting period of time. There's a lot going on clearly in this stage from 20 to $50 million. That concludes our episode today. Thank you so much, Eric, for sharing all of that wisdom. This is a part of our series from startup to $250 million. And today's episode was all about that 20 to $50 million range. And can't thank you enough, Eric, for all the great advice and for all of you business owners out there. Any parting words, Eric?
Yes, and thank you all. And I got to tell you guys, business is fun, right? Business is what I enjoy, and I know what you enjoy. It's your passion, your baby. This is going to be a blast when you're in this 20 to $50 million a year stage. It is amazing. So enjoy it. It presents a lot of challenges. Enjoy it and look for experts to help guide you along the way so you can move up quicker, faster, and better and reach your goals.